Did you know investing in fixed income funds is as easy as investing in money market funds? And these two accounts works almost the same way with very few differences. And today we are going to be looking at these two funds to see which one is a better investment than the other. We'll also go through different companies. We go through their fixed income funds and their money market funds so that we can appreciate the differences between the two companies. And again, we have receipts for these, all right? So let's start with the structure and what each of these fund is, because I think that is where the differences start, and then we can move from there, okay? So fixed income funds are a collective investment scheme that collect money from or funds from different people, and these funds are invested in bonds issued by corporation, government agencies, and sometimes even foreign entities, which means government, corporations, or financial institutions from other countries, yes? And on the other hand, as we have said so many times in this channel, that money market funds are a collective investment scheme that collect money from different people, and then they invest this money in low risk, short-term investment, majority treasury bills, certificates of deposit, and also commercial papers. Yeah. So from this definition, you can see that these funds invest in different things. Fixed income funds invest in bonds, which are long-term, while money market funds, they invest in short-term instruments, basically or ideally treasury bills. While MMF, they invest in short-term instruments, basically the treasury bills, yes? And ideally, the long-term instruments, those are the bonds, are supposed to offer more returns than the short-term ones, yes? And meaning that fixed income funds are supposed to give more returns than money market funds, but we are going to discuss that in a short while, yes? First, let us talk about the similarities. Both money market funds and fixed income funds, they are regulated by CMA under collective investment schemes regulations. So they must follow these regulations of the collective investment schemes, and they should both have a custodian and also a trustee. The custodian is supposed to be keeping the money for the fund manager and or handling the money for the fund manager, while the trustees are supposed to be making sure that all the rules are followed by these fund managers. The rules by CMA are followed by this fund manager, okay? So before you invest in either of them, make sure that the company that is the fund manager, make sure that the company that is the fund manager and the fund itself, the fund that you have invested in, can be money market fund or fixed income fund, make sure that they are licensed and regulated by CMA. You can check this information in CMA website to make sure. Now, both of these funds, they have the same level of risk because they invest in low risk investments, and none of them is riskier than the other, okay? Now that we have covered the similarities, let us go to the differences. And because we have a few notable differences, but this differs from fund manager to fund manager, and we are going to give examples so that you can appreciate the differences from the same fund manager, okay? Let me start by saying this, that these two funds are supposed to look very different, or on paper, these funds are very different, but the Kenyan fixed income funds, they have evolved so much, and some of these fixed income funds, they look exactly like money market funds with very few differences. And I know we still have some fixed income funds that look very different from the same fund managers, money market funds, but most they have very few differences. So we are going to look at these companies, and before we do that, maybe we can look at how the fixed income funds are supposed to look on paper, or the differences that are on paper. Then we can move to the reality of how these fixed income funds look like, okay? Number one, the fixed income funds are supposed to have more returns than the money market funds because long-term investment instruments give more returns than, or better returns than short-term instruments, yes? Number two, money market funds do not have a lock-in period, and you can withdraw your money at any given time. For some money market funds, you can do instant withdrawals, while others you can do 2 to 3 working days. While fixed income funds are supposed to have a lock-in period, and they should offer periodic returns to the investors. In short, money market funds are supposed to be more liquid than fixed income funds. Basically, the fixed income funds are supposed to be more suitable for investors who are looking for long-term investment. Yeah. And the last thing difference on paper is money market funds are supposed to be safer than fixed income funds. So that's how they should look like on paper. But how do these accounts actually look like in reality? Before we cover that, if you have come this far in this video, please hit the like button, and for those who are new to this channel, welcome to the community. Make sure that you join the community by subscribing to this channel, and we usually talk about investment opportunities, we do reviews, and soon we'll be talking about how to make money. And I mean, we can't speak about investment if you don't have money, right? So make sure that you don't miss it. Start with Etika, because I think their fixed income fund looks so much like their money market fund. So here, from this, you can see the only difference is first the interest rate. Their money market fund has a higher interest rate than the fixed income funds, and then the other difference that is notable is the benchmark, and you can see the money market fund benchmark is 91 day T-bill plus 1, and their fixed income fund benchmark is 182 day T-bill plus 1%. Next, we are going to look at the lock-in period, and at this we look at Orient Asset Managers and Madison. The MMF for Orient Kasha does not have a lock-in period, but their fixed income fund has a lock-in period of 90 days. And for the Madison MMF, the MMF does not have a lock-in period, but the fixed income fund has 3 months lock-in period. For Etika, they both don't have a lock-in period. The other difference that I want us to look at is when the interest is distributed to your account. Although most fixed income funds have evolved, as we have mentioned earlier, some still have a difference when it comes to distributing the interest that you're earning to your account. And money market funds can be distributing returns daily to your account, while fixed income funds, they can be distributing interest to your account monthly, or they may be distributing interest monthly to your account in the money market fund, but for the fixed income funds, they distribute semi-annually or quarterly. And a very good example in this case is CIC Money Market Fund, which distribute the returns monthly, but for their fixed income fund, they do semi-annual distribution. This means that the interest that you're going to be earning is going to be sent to your account semi-annually, right? So basically, the main difference between these two accounts is where the company invests or puts the investors' money. The rest, it depends with the fund manager. Now, why should a company have these two accounts that look very similar? The CMA have regulations on where to invest for each of the funds, and that's the reason why a fund manager may choose to have both of these accounts at the same time. It can take advantage This allows them to take advantage of both the short-term and long-term securities. The regulation states that money market funds should not invest in long-term instruments, so just to make sure they remain liquid and can provide stable returns with minimal risk. And if a company wants to invest in long-term securities, they need to have a fixed income fund. So when investing in a fixed income fund, make sure that you look at some of the things that we have mentioned here. Just know what are the conditions of the fund. Don't invest in one that has a lock-in period if you need that money maybe in a month's time or before the lock-in period is over. For those whose accounts are alike, always go for the one that has higher interest rate. And if you're in a money market fund and his fixed income fund is doing better than the money market fund, you can always move your money, yes? And don't get me wrong, I'm not saying that you keep moving your money from back and forth from one account to the other. You can monitor the returns of each for a while and make your decision, or you can put some of the money in a fixed income fund and the other in a money market fund, especially if you have different goals. You can put money for one goal in a fixed income fund, and then you can put the other amount in a money market fund. And if you have different goals, you can open different accounts for each. Okay. And if you're looking for another investment opportunity, here is an investment with up to 45% returns in investment. Make sure that you watch it, and happy investing. Bye for now.